I kind of understood what kind of a bit of a sham that world is. And, there's a lot of people who think that they can just own a couple of rental properties and buy a
Sure.
300-unit apartment complex. But looking back on it, it was necessary to get to the next stage, I suppose. Because like one of the big things, if you want to be a general partner or you want to take down these deals, you need the loan guarantors and the people who've done the deals in the past to sign on the debt. So
Welcome to Investing for Generational Wealth. I'm John Clive from Clive Capital, where we help high earners just like you invest outside of the stock market to passively achieve a passive income, long-term passive income, or cash flow and tax benefits. And we do it with superior risk-adjusted returns. Together with investors, we're investing in over 1,000 multifamily apartments under renovations, over 500 single-family rental homes, and we're investing in over 350,000 square foot of industrial real estate, over 700,000 of private loans, and much, much more, expanding into oil and gas and other type of asset classes. And we're here to help our investors, our customers, create diversified, balanced portfolios. Before we begin, a quick disclaimer, like always, we're not financial advisors. All investments are subject to risks, including the possible loss of the money you invest. So perform your due diligence before making any financial decisions. And of course, consult your CPA, your financial advisor, and others before making any investments. Again, I'm your host, John Lai, and welcome to today's episode, transitioning from rental and other income into real estate syndication with Lane Kawaoka. And Lane is founder of The Wealth Elevator. He's a host of a top 50 investing podcast at simplepassivecashflow.com. He now manages a real estate portfolio exceeding 10,000 units, spanning multifamily, RV parks, mobile homes, and hotels. And we're excited to have him here because just like many of you in the audience, we have a good proportion of investors who started with residential real estate, are interested and considering transitioning to commercial real estate, and his experience is very apropos. For those of you who don't know your journey, Lane, could you give our audience a brief description of how you got to where you are today?
yeah, thanks for having me. Started in 2009, I think a couple years out of college. I was up in Seattle, Washington, and engineering degree. So I just started to work for the man, started to save my money. Was always a good saver and made a decent salary back then. So I was maybe saving 30, 40 grand per year. And up until this time, just following what I call the linear path with his, invest in the 401k and, go get a good paying job with a degree, right? So, and part of that is buying a house to live in. So that's what I did in 2009. But because I was traveling all over for work, because a lot of young professionals have to do that kind of stuff, which is fine at the time. I didn't have a family back then. I just was like, it was kind of weird. I was only home on Saturdays because I was traveling the rest of the time. And I just, on a whim, just decided to rent it out, which luckily kind of got me the taste of cash flow. And I was like, wow, this is pretty easy, So, that's where I got the bug. And then, bought a handful of more rental properties and then bought some more, saved some more. At that point I was like kind of turbocharging my savings, which went to buying rental properties, maybe $100,000 a year savings. So I think that's a big part of this is, how much can you save and plow into investments? But 2015, I had 11 of these little rental properties. A lot of it was remote. For Atlanta, Birmingham, Indianapolis is kind of where I invested in at that time. But that's kind of, I think, that maybe that aligns with some of your audience, right? Like, I think we all kind of start there. Single family homes are kind of the prerequisite to all of this.
Yeah, and I would say like house hacking as well, especially for those that are just starting out to buy a home these days, especially in the Seattle, San Francisco, New York area. It's just untenable. So house hacking or renting out part of your home, that's the only way to do it. So how did you transition from residential to commercial then?
Well, I had a lot of pain in the single family home world, right?
Yeah.
Like, I had professional property management and, these properties were all remote to me. So I had a few property managers in each geographic area. But you get to a point where you can't get it that many Fannie Mae, Freddie Mac loans. I think you can get 10 in your name, 10 in your
Right.
spouse's name. And then it just became like a chore, right? Like with that many rentals, I had maybe an eviction or two every year. 1/3 of those evictions, resulted in somebody's stuff getting thrown out on the streets and big repair bills, like 5, 10, 20 grand repair bills after that.
Yeah.
And I was like, what am I doing this all for? Like, and then, not to mention all the little headaches that have come up every quarter, like a tree falling on the house, some kind
Yeah.
of big flood in the basement you got to fix, and you got to like stay on top of the property managers to fix that stuff. But, at this time, I was like, what does any logical dude do who has some success with single family homes? I mean, I was making a few $1,000s a month passively doing this stuff after expenses. So I was like, that it was working, and what logically do you do but buy more? And
Yeah.
this thing called multifamily made a lot of sense.
Right.
So I went into, I was like, oh, let's go buy some apartments. And I got around a lot of other, newer people doing the same thing too, got into ethos per se, and just started to learn how to underwrite larger deals, because it is very different than your little single family home, spreadsheet for sure.
Mhm. Mhm. And did you go into some type of mastermind or training program? Because it is very different. And to be able to underwrite even a small apartment complex, but call it more than 20 doors, it gets complicated.
Yeah, and boy did I, John. Boy did I. Probably spent way too much damn money on those silly programs
Yeah.
out
Right.
there. Um, I mean, I guess what I got out of it is like I learned how to underwrite deals. I kind of understood what kind of a bit of a sham that world is. And there's a lot of people who think that they can just own a couple rental properties and buy a
Sure.
300-unit apartment complex.
Yep.
But I mean, looking back on it, I mean, it was necessary to get to the next stage, I suppose.
Mhm.
Because like one of the big things, if you want to be a general partner or you want to take down these deals, you need the loan guarantors and the people who've done the deals in the past to sign
Right.
on the debt. So, generally speaking, the people who sign on the debt are key principals, the KPs, the loan guarantors.
Mhm.
Their net worth needs to be greater than or equal to the loan. So if you're buying like a $20 million property or loan, you need a loan for like a $25 million property. You need 4 guys at $5 million a piece. And, you're not going to find that with your lowly band of other friends and family nearby who thought you were even crazy for buying properties out of state,
Right.
sight unseen. They're certainly not going to sign up to sign on debt with you for that stuff. So you got to go to the Mecca where all these other crazy people are signing on debt. And and the crazier thing is like some people who with experience doing this is willing to sign on new people's deals. So,
Yeah.
yeah, I mean, I think I was lucky enough to like kind of pay. I had a lot of money to kind of blow on this stuff. Plus I wasn't married at the time, so I could kind of do whatever. Was it all like a waste of money? Yeah, it was a lot of wasted money, but I mean, that was kind of my path through this for sure.
Yeah. You definitely have to, it's almost an education, right? You either get your education through these masterminds, you get punched the ticket, but it's either that or you get your education through failed investments. And it's better just to learn alongside others and get your education that way than any other approach.
Yeah, I mean, they teach you how to like underwrite deals, but like 95% of the education is about the acquisition, like before you buy the damn thing.
Right.
None of it is like, oh, okay, we bought this thing. Now, what do we do now? Right? Like
Yeah.
that's
Yep.
all kind of learning on the job. I think we were kind of lucky enough to, go through some smaller deals, some Class C deals. Certainly a lot more things break or happen on those types of assets, like kind of owning an older car in a way.
Yeah.
And then kind of learn by doing. I think first deals we syndicated maybe 2017, I think. I know
Yep.
18 for sure. But yeah, just kind of doing the smaller Class C deals, the ones that nobody wants, and the broker's like, give it to you guys. But that's the hard part, right? Like a lot of these deals that the brokers give to any guy off the street is just going to be garbage deals that
Right.
just don't make any sense. I mean, really, maybe like less than 1% of the deals you even want to put an offer in on.
Yeah. how did you move up from there then? How did you go from the Class C to Class B and A? I don't know what your buy box is, but assuming Class C to Class B, how did you move upstream?
Yeah. I mean, I think initially we wanted to get anything that they would give us that was a deal, right?
Yeah.
So you take what you can get. And plus, when you're starting out, you're kind of forced to like smaller deal sizes because you just can't, quite frankly, can't raise the capital.
Right.
Like I remember some of those earlier deals, like even like 130, I think it was 130 something units. Like it was a handful. It was in a Class C area, and the collections were like 80%. But that's kind of typical of these Class C turnarounds. That's why when you look at deals from an underwriting standpoint, which I do think might be outside the scope of a passive LP investor.
Right.
I know we have some analytical types on the line here. May not be good investor etiquette to kind of come off guns a blazing and asking some of these, what's the reversion cap rate? What is the full occupancy and economic occupancy your first year, then the second, then the third, then the fourth, right? Because you kind of peg, and especially if you're a dude who has under $2 million net worth, right? Like a good operator probably doesn't want to work with you because you're just too much.
Yeah.
Too much. But these are the things you kind of quietly look for in deals. Like in some of those early deals, like even after we owned it for like 2 years, like 80% collections was like about the best we could get on these things, which means
Class C.
Yeah. I mean, like it basically means like out of, 10, 100 people, 20 people are just deadbeats in the property if you had it fully occupied. Right.
Yeah.
But that's just how it goes. But you can make a lot of money in those types of assets in the neutral market. So, but we're no dummies, and it's like, man, this is just difficult working with people. Not to mention, the construction and all that is one thing, but when you're working with people, people who manage people know what a problem people are for sure.
Right.
And, it's difficult clientele. So we've kind of, went to higher end properties. The Class A stuff, the price per units just don't make sense. Just, it doesn't work. No different than buying in luxury condos or high price Class A areas in California, Seattle, New York. Just the numbers aren't going to work there. I think in 2020, we kind of hit our stride when we had a lot of deal flow thrown our way because it was the pandemic. And the way the brokers work is they throw the top guys the deals, and when they give it to you, you take it, right? It's like a waterfall going. But I think even then we were kind of getting the inkling that anybody could just do multifamily. So we kind of started to like look what else was out there. Because, truth is any 4 guys can sign a few $1 million, can sign on the debt and take down a large apartment building. So those are the people you compete with that are pushing the pricing up. So we eventually, started to do developments, right? Ground up developments. So we completed a 200 unit and the 300 unit. But the scrutiny to get the loans is a little bit higher for this stuff, right? You actually have to have real experience doing it as opposed to just being the net worth resume. And then, the 21, 22 correction happened. We got hurt just like everybody else did. But they didn't. They're lying. Haven't gone down yet. And I think what we've seen the last few years, or, since the summer of 22 when interest rates went up, I mean, you go look at the CME financials, these are rate cap providers that predict the rate caps or the interest rates. I mean, it's my thesis that interest rates aren't going to be coming down under 3.5%, 3%. We're talking Fed rate here, right?
Right.
Which influences the 10-year treasury. But that means like we're not going to see 75% loan to value on most deals as a standard. And today you're looking at in the 50s. And the deals just don't work because you have to bring so much more to the table, not to mention interest rates are higher. And then when you combo that with like, on some of our properties, like the taxes went from when we bought it in 2019, I was looking the other day, it's like $150,000 a year. And it went to like 400, 450. And this is after appealing all that stuff and everything. It's just like, geez, like
Yeah.
how do guys get a break? Well, I think the answer is, especially in a high interest environment, which we're stepping into this next decade, you have to go to more audacious business plans. You got to add more value.
Yeah.
Or private equity, or, get it, I think, at the top, we're saying, like, I started with a lot of single family homes. And to your point, you're saying earlier, a guy can't just buy a single family home for $1,000 a month rent and buy it for $80,000. No way. That thing is worth 140 today.
Right. Right.
And that's sort of just a one data point and indicative of the market.
Are you seeing insurance as a factor as well in terms of prohibitive costs?
Oh yeah. Yeah. I mean, I think we sold some assets kind of prematurely in Gulfport, Mississippi. Like, probably one of the worst places, that in certain parts of
Yeah, I
Florida,
was gonna
right?
say Mississippi.
Yeah. I think I always, I'm here in Hawaii. We kind of run things remotely, so we can be more flexible where we go. But when I see always the hurricane footage, it's always like, oh, there's Biloxi. We
Right,
were there that one time.
right.
But yeah, we've seen that triple since, and some even quadruple. And this is like 3-4 years ago. This is in 2020. I recall this,
Yeah.
these insurance rates were skyrocketing. And then it's funny now, right? Because now all the HOAs, insurance and taxes going up for the regular Joe. And it's like, well, yeah, this has been happening for a few years now. We weren't making
Yeah.
this up,
So have you moved on from multifamily to other asset classes? And I would imagine your buy box has changed, but other asset classes.
Yeah, I mean, my buy box is like, you put it into the analyzer, you make some conservative assumptions, specifically around like the reversion cap rate. You want to assume that you're selling it into a weaker market. You don't want to assume you're in full occupancy or economic occupancy over 92%. So you use some good sound underwriting standards, or what we call assumptions.
Yeah.
And I think that's for investors. Sometimes they put these in pitch decks. Most times they don't. But I think it really can throw projected returns one way or the other. But we run it through ours. Just like, if I see a deal, and if I can, get close to doubling my money in a handful of years, then I think that's that waterline, right?
Yep.
But it hasn't. Summer of 2022, interest rates started to skyrocket.
Yep.
Nothing worked, right? Because your debt service, your coverage ratio fell so hard. It was just like, no, bueno, I'm not going to work. Since then, that was like 2-3 years ago. Everything has kind of come down 20-30% off those peaks. But I don't think we've yet to see, still the interest rates are high. So, I mean, from a price standpoint, now's the time to buy stuff if you're buying cash. But, most people don't do that, right? They use some form of leverage. So the other part of the equation, maybe even the bigger part, is what are your loan terms? And I don't think we're there quite yet. But once it hits equilibrium, man, we're off to the races again. I guess, and every deal is different, right? Like, I'm just talking high level here, right? But you always look at the right submarket and specifically the right deal with, maybe there's some type of distress on the seller's end. But that's kind of what the buy box is. Anything that makes money on paper, and then you kind of look more into it. But it's required us to put out different lobster traps out there, right? Like, we got the lobster trap for the multifamily 100 to 300 unit class BC. We've got the we've got like another lobster trap for super high turnarounds or development deals. We've got another lobster trap for buying businesses, private equity. A lot of our folks own businesses, and that's what I equate to as a big lesson learned going through this. It's a lot of it's the people that you're working with, the relationships that you cultivate, the ecosystem that you create, and that also helps you get deal flow in terms of what maybe somebody runs a pool cleaning company. That's in fact somebody we talked to the other day. They were a vendor in our properties, so we get to know them. They do what they say they're going to do. Then you start to meet the owner, And then, maybe they invest with us, but maybe we invest in their company
Right.
too, right?
Right.
So to me, it's like the tides and the plentiful fish and crab or whatever you want to call it, crustaceans have gone down. So you just got to put out more lobster traps and sort of be asset class agnostic out there a little bit.
Yeah. Your analogies of lobster traps are great. Make me hungry. And that's really interesting. Like we're doing that as well. We're looking at outside of multifamily, right, into oil and gas for slightly different reasons, but like certainly asset diversification or asset class diversification. Also from a tax strategy as well, trying to formulate a tax strategy for our investors in our portfolio. RV parks, you own some RV parks, hotels, self-storage. I don't know if you have certain areas within the US that you like investing in, but what asset classes do you favor now versus maybe multifamily? You're keeping your feelers out, but there are other asset classes that maybe have a higher equity multiple or IRR.
I mean, RV parks cater more towards, it's kind of like short-term rentals, right? Asset
Right.
class. Like when times are good, times are really good. When there's a recession, hold on to your butts with your Airbnbs, guys, right?
Yeah.
And your
Yeah.
RV parks, right? Because it's more of a vacation type of asset, discretionary line
Right.
item on people's spending. So that's why I'm not a huge fan of that per se. But let's say it's not a great investment. I'm just personally doesn't really line up with what way I see the world.
Yep.
I've got mobile homes, but I think the thing there is like it hasn't gone through as much turmoil as multifamily and office.
Right.
Right. That's kind of what makes the deal. And I think that people may need to listen to that twice. But you go whether there's distress, right? Like prices drop pretty drastically in multifamily because people had bridge debt that expired.
Yeah.
And they had to dump the asset. Whereas mobile home parks typically owned by a mom and pop owner that sometimes they just don't understand how to get a loan, so they don't have debt. And so they're not really not really pushed to sell during a downtime. So there wasn't really a downtime in that sector. So people will look at that and they'll get mixed up in the marketing and it's like, oh, mobile home park operator XYZ, things are great, right? It's like, well, yeah, things have been great, but doesn't help you get good deals. Right. I mean, I kind of I'm a bit of contrarian investor. You got to look at where the pain was. Another place that there's been pain is, just for example, people are interested in like e-com businesses and SaaS businesses. Like 3 years ago, there were a lot of aggregators rolling up that stuff. And boy, was that, I mean, you talk about multifamily bloodbath. That was, this probably trumped that bloodbath. So, now's kind of the time to kind of look into that sector in my non-investor advisor facet opinion, right? But that's not what people do, right? People they look at what's been hot and they just invest in it again, right? Just like how they pick mutual funds or ETFs. Just like when they go to Las Vegas, right? I don't gamble, but when I do, I'm an idiot. I go to the one that has the most people on the craps table and I go there.
Yeah.
So dumb, right? And I go there and then I'm not, next few turns, the 7 comes out, right? Investing, I'm just there to have fun, but investing wise, that's typically not what you want to do. You want to go to like, what is it that's on discount that everybody's talking about, distress. Now, something like office, I'm like, yeah, that fits the category, right? There's a lot of pain and anguish there, but I do think that there's somewhat of a fundamental change in how we've been using office.
Right.
That people forgot that we had that pandemic thing a while ago where we thought everybody had cooties and we didn't go to restaurants unless you had a card and we didn't want to go to work unless we had to.
Yeah.
So that's, you look at the occupancy numbers, it tells the story right there. But yeah, that's kind of my lowdown on some asset classes. I mean, self-storage, I think my thing with self-storage, I've done a little bit of it, but I think with self-storage, you have to turn it into Class A as soon as you buy it. Well, you have to make it where the spouse can go at night in air condition and it's safe. You know, it's not like multifamily where you can get by with going from a class C to B or B to B plus. You with self-storage, it has to go to that nicer level. And that in lies the issue. Now you're competing with every brand new square box locker system that pops up tomorrow. And it's super easy to build these damn things, right? Think about it.
Yeah.
It's just a box, lockers.
Right.
So then, you can buy an asset, but if next door somebody just decides to build something in 6 months to a year, which is a lot faster than building regular multifamily, which can take 18 months to 2 years, they're going to compete directly with you. Whereas if you buy a class B multifamily and then there's a brand new class A, yeah, it's going to impact you for sure. But in a way, once things kind of settle out after the first couple of years and, supply and demand kind of evens out again, in a way that neighbor kind of helps you, in a way, kind of pushes the market up, because there's always different types of clientele out there. Not everybody can afford a $1,500 a month rent.
Yeah. That's why I think mobile home parks, if there is a recession, if we're facing tough times going forward, Class A is probably going to be impacted the most, right? And then they're going to push down all the residents down a level, Class A to Class B, Class B to Class C, and then eventually down to mobile home parks, right? For mobile home park residents, there's not much more you can go, right? You can go and live on the streets, but most people will just stay in mobile home parks. It's not going to be that variable. They're not building or allowing very much construction or leasing in new mobile home park. And so the supply is pretty stagnant, whereas the demand, I think, will still be there. It's an interesting asset class. We haven't looked at it, but we're interested in looking at those.
Yeah. I mean, just to confuse people even more, with mobile home parks, I've done a few deals like that. Everything you said is correct. But there's a little wrinkle in it. Is a big part of like the revenue is selling the homes.
Homes, right.
So I think it's actually very it's fragmented income in a way. Like if you're not selling homes, it's not super spectacular just relying off the cash flow that does come in from those lots.
Right. That is correct.
And then the debt in that world is much more difficult to find. And that's what kind of makes the deal. And then the property managers, you don't have property managers as ready available. So oftentimes the general partner needs to go hire people off the street and pretty much do it in-house. So it's got its issues for sure. I mean, it might be a good investment if you're just a cash buyer and doing that type of stuff. But the fact that you don't have like really good leverage options kind of makes it, I mean, maybe it's categorized as safer, but you don't have that reward aspect because you can't juice it with good leverage there too.
Yeah. I see a lot of operators because, as you say, a lot of them are owned by mom and pops with no debt. They'll get seller financing and operate that way. And so that's potentially a better alternative to securing agency debt or bank debt and trying to go that route. I think it is its own asset class. It has its own potential obstacles and hurdles to overcome. Yeah.
Yeah. Yeah. I mean, that's why in that world, people who are the mom and pop owners, they typically won't get debt. So they can do those seller financing activities. And, typically seller financing kind of screws the seller, right? I mean, I don't know why anybody would want to do seller financing. I mean,
because they just
already have a lot of money.
Yeah, right.
Care.
They want the mailbox money, right? Because they're retired.
Yeah. I mean, but it's typically not the smart move in most cases.
Yeah.
And so you usually gotta try and find a sucker to do the seller financing.
Right.
And I guess if you own a mobile home park for 40, 50 years, maybe you kind of are. I don't know. But then I'm like, all right, well, why don't we get seller financing on a business? The upside is way more there, and you don't have like all this physical liability of like, most of the mobile home parks are pretty nice, but it's like you're still dealing with people at the end of the day.
That is very true. Yeah, I mean, if you look at ultra high net worth individuals and you look at their portfolio, businesses make up a good third, right? 30% or so. And then real estate make up probably another 20%, their equity investments, another 20 or 30 or so, and so forth.
I mean, there's two kinds of people out there, essentially, right? If you made a scatter chart, if you're into that type of stuff.
Yeah.
But if you're just working a W-2 salary, yeah, sure, you might make 300 grand a year or whatever. Maybe you're a doctor, but you know, usually you don't see these guys get over 3-4 mil net worth by the time they hit 50 or 60.
Right.
It's not possible. But if you're a business owner, it's unlimited what you can get.
Yeah.
The thing is, not everybody has the cojones to be a business owner.
Right.
So it is what it is. But I think, you can still be a good investor and be a salary guy too. And you can get to what I call, like, I define end game for most of my folks as 4 to 5 million net worth. You get there, you're good. You can just kick back and buy some life insurance or buy some T-bills. Again, I'm not giving any tax or legal
No.
advice or investment advice here, but like, I think maybe I did coin the T-bill and chill hashtag, but it's like, that's the idea. It's like, get into equity, get your net worth up. Sure, it's more riskier, but if you can get to that threshold, then you can kind of just relax at that point. And you don't have to run a very risky business. You can just be an investor, a passive investor, to get that point too.
I'm just curious, what would you do if you had, call it 3, 4, 5, and what would you invest in? At some point, you call it like 4 to 5 at the 4% rule. You'll be making enough, depending on how you spend, but you'll be making enough to cover your expenses, right? You can go 5 pretty quickly. But what would you invest in?
How old is this person? Like,
call it like 40, 50.
I think you're good. I mean, I don't think you need to invest in any of this type of stuff unless you want to play the barbell strategy and maybe do, 1 to 20% of your net worth into fun stuff like this, which I think is fun. Right?
Yeah.
That's why I do it. It's kind of fun. But if you're super conservative, then I don't know why you're listening to this podcast. like,
right.
Just invest in T-bills or whole life insurance. Dude, we do the credit investor banking style, right? Where you just overfund the policy. And I think right now you get like 4 or 5% tax-free and then off the table litigators. And that's your milk ticket for the rest of your life.
Nice.
At that point.
Nice. Okay.
But 4 to 5 million is just a general thing. Like, I have clients that have young kids that are teenage years in California. That may mean that their number goes up to 5, 6 mil.
Yeah.
Some folks that are, empty nesters, might be 2.5 for all we know.
Yeah. I have 2 questions. They're unrelated, maybe. One is tax strategies. Obviously, like a lot of this real estate, have tax implications. And so depreciation predominantly, your cost seg and all that. So you can write off all of those. But are there other strategies that you've seen in market? I've seen charitable contribution, bringing down the AGI, right? But any tax strategies that, knowing what you know today, that you would impart? Obviously, owning businesses is one of them.
Yeah, I mean, owning the businesses, doing the C Corp, S Corp determination, I think that's small potatoes. I mean, the big one is just get passive losses through investments.
Yep.
The real estate does it, especially doing cost segregation extracts more of it.
Yep.
You pull up those losses and then maybe you implement real estate professional status, maybe buy a rental property nearby. Yep. But if your AGI is under 400 grand, you don't need to do any of that type of stuff. You don't have very much high taxes. I call it AGI smoothing. You just want to make sure your AGI doesn't explode into the higher tax brackets, or in certain years, it doesn't go too low. And if it goes low, that's when you kind of sell assets or leak money out of your pre-tax or your 401k stuff to personal, right? To bring it up, right? You always want to kind of keep yourself under that threshold of 400 currently today. I do a lot of sometimes I bust the chart out. We're not doing screen shares here, but that's just general idea, right? Certainly I'm not giving any tax advice, right? You got to be silly to listen to a guy on a podcast about Like it's all specific. And this is what I think is fun. It's all personal finance. Everybody's got a different situation. Now, some people kind of did it the wrong way where they have 7 figures in their 401k and now they got to take that stuff out. Get killed with taxes because their income is high. Totally different plan there. Some guys don't make that much money and they don't have a tax problem. So whatever, it doesn't matter, right? I think, I always tell my guys, like, you guys have to learn this stuff on your own. It's not a matter of just getting some CPA to do it for you, right? If the CPAs are just going to do it the easy way.
Right. Yeah.
Think
And the
about it,
safe
guys.
way,
Like,
frankly. Yeah.
yeah. Yeah. I mean, you have to empower yourself to guide the situation. Since you said you like my analogy, it's like, I had a friend, just doing actually it was my wife's friend, I think. They were doing like a bathroom renovation and they're like, basically gave the contractor a blank check. Like, oh, make me a nice bathroom. I'm like, that's the dumbest thing I've ever heard. It's like, you basically just gonna like run up as much money as possible to get whatever. No, that's not how you do it. And that's not how you do your taxes. You need to know what you want to do. The CPA's job is to kind of put it into the forms and technically, but your job is the strategy.
Yeah. That's a great idea. Yeah. Like this year, we have a HELOC. Never was able to write off the interest on the HELOC. So this year we're thinking about doing that. We need the write-offs.
Yeah. I mean, that kind of, I think they closed that loophole maybe like 4 years ago, right? They said that, oh, you can't write off the HELOC thing. But then the way around it is like, you have a business. Your business is in the pursuit of making money, right? Whether that's an investment business, whether you're buying and selling Pokemon cards, you're using HELOC for that to make money, right? It's in the pursuit of, it's a business.
Right.
And maybe you wrap around a nice LLC to make yourself look a little bit more formal through it. But if not, it's like the idea of like, if not for taking out this HELOC to pursue your business venture where there was a potential of making money and losing money, you wouldn't have done it.
Yep.
So you take it as a business expense anyway. Of course, I'm not a CPA. I am not. I'm just telling you what I heard from the other guy on the last podcast. So I'm just mimicking and repeating,
Yeah, we're just having fun.
Just having fun here, guys.
Yeah.
Don't take this seriously. But, but you see, you got to kind of think about some of these things, right? Like nobody's saying to steal or not being truthful. That's not what we're saying here.
Right.
But
use the tax law to your advantage.
Right. The tax laws are written to it. The way I see it, the spirit is to allow people incentivizations to go out there and take some risks. And because that's what powers this country forward. Not people sitting on their butts, just churning and doing nothing. Okay. We need people to do the oil and gas stuff. We need people, because that's hella risky, man. That's why you need to put so many like tax benefits around it. They need to be able to buy real estate, right? And it's the government. It never really makes sense, right? Not supposed to make sense.
That's right.
But it is what it is too. But I don't know, man. I mean, talk to your own CP on that one. But like, if you're using the money, you can show that you're using the money for a business venture, not the house that you're living in. That's not a business venture. No. But if you're using it for a business venture, buy Pokemons, resell them, whatever, that's your business. Then why not? Right? I mean, you're being truthful. I mean,
my other question was, are you using AI today? So generative AI is big. Businesses are starting to use them. I haven't really seen it used extensively in either real estate or passive income, real estate adjacent ventures. Have you used it?
I never use AI. I write all my emails and I like to stay up as long as possible. And I because I have so much confidence in myself that I feel like I'm better than the collective knowledge pool of the world.
Right.
Right. I mean, I use AI all the time.
Yeah.
Right. Like it's a big tool. I mean, the smart, creative people are going to leverage it and, hopefully use the time savings I try and spend more time with my family and, talking with people and building relationships. That's what it's supposed to do.
Yeah.
It's just a leverage.
And I had meant not necessarily use AI for email copy or marketing copy, but in novel ways, right? Like things that will make money essentially. Have you seen or used AI in a manner that is very novel, and agentic AI especially is, coming
Oh yeah. I
forward?
mean, for passive investor use case, yeah. I mean, take a pitch deck, take P&Ls, rent rolls, throw it in ChatGPT as attachments and say, can you analyze this property?
Yeah, for
Is this a
risk.
good investment? But I
Yeah.
think this is kind of where like you need to have some base understanding and knowing, because it's going to spit stuff out, but it might go over your head.
Right. Or it
And
might
a lot of
hallucinate, right?
it's not going to hallucinate. I mean, hallucinations are kind of what boogeyman kind of stuff. I mean, you have to have a human, like you have to have some kind of concept in what this stuff means.
Yep.
If not, it's going to go over your head. Or you need to query it like, oh, what's the cap rate on this type of stuff, right?
Yep.
I mean, you can correct for the hallucinations if you're so like, I mean, if you're so untrusting of the system, you can say, well, that number 5.6, where did you get that from? And backtrace it, right?
Yeah.
But generally speaking, I mean, this stuff is just for entertainment purposes, of course, anyway, too. But it's just to kind of key in on like, okay, what's cool is now you can say, well, give me a list of 8 risks on this deal and then rank them, right? What is the actual things that actually I should actually worry about? Because I think that's where sometimes the machines do a lot better than a mediocre passive investor. Mediocre passive investors, they worry about the strangest of things. And it just doesn't make sense. And I'm like, well, if you're going to do your due diligence on something, spend the time on like the big 80-20 things. But I think that's where AI comes into place. Like a lot of people just don't know. They just don't like, they don't even understand the terms and the questions to ask, right?
Sure.
There's,
Yep.
4 stages of learning. The first is you don't know what you don't know. The second stage is at least you know what questions to ask. You know what you don't know. And I think that's where AI can really help. You can ask those questions and it can query and it can sort of, create the response in a way that you can understand. And then you query off of that to get further understanding on what those, and you can kind of teach yourself that. But I think that's what's hard. Like if you're a complete newbie, makes sense to kind of read some books, but I think the best way is like, talking to an operator. And this is what we say is like, look, you're going to read all these books. You're going to go to this course. You're going to be an academic genius on this stuff, but you're going to be super uncalibrated. The best way to do this is to get on the phone with us and like, we just have a dialogue. We just chit chat about something, and do that. Like, that's the experience, the lessons learned, like what actually could happen out there is a lot. For some reason, as humans, we absorb that a lot better than a bunch of copy pasta from AI.
Yeah.
And that.
Like that. 2 questions we ask our guests. 1, think about a younger version of yourself, 20 years younger. What would you tell that 20-year younger version of yourself?
I still don't have no regrets about being an engineer. I might have not wasted my time for a couple of weeks getting my PE. That was a waste of my time. And then the grad school engineering degree. But, I think the engineering degree got me the job, which then I was able to save my money to buy the rental properties, to get into the bigger deals. Certainly, got me a Fortune 50 company job starting out. And I think that was helpful. So, I mean, I don't really have any regrets going down that path. Like I believe that everybody should, that's like in my new book, The Wealth Elevator, there's different floors of the wealth elevator. The first floor is where I was at in my 20s, going from, a little bit of student debt to $1 million net worth, a credit investor, and then investing in syndication private placements at the second floor. And then now I see that what's on the 3rd, 4th floor in the penthouse. What are other people doing out there? So I think the biggest thing is understanding what floor you're at and then try and apply the strategies on that section. Like that's yeah. So ask me, so 20 years ago, yeah, I was kind of doing the same thing. Should have done, maybe I shouldn't have bought 11 rental properties. That was probably way too much. And it was a real pain to sell those things one by one. But whatever.
Yeah. And you learn, which is great. And thank you for that. Do you want to talk a little bit about the Wealth Elevator, your book?
Yeah, it's not written for broke guys in the basement, which we define as 50 people who make under $50,000 or less, and don't have a job. Those are the people I think will gravitate towards wholesaling or flipping houses because they're broke. My book is mainly focused around accredited investors. Like, what's the next stage, even from maybe where you're at now, or what's even after that when you go over 10 million, $100 million net worth. I'm kind of in there, and I kind of work with, bigger players. So I've kind of taken some of these lessons learned, and it's all like experiences from the first, second, third floor of myself. But, I wanted to make more of an actionable book, like strategies, what to do. And, unfortunately, I think that's what's hard is like, there's so much stuff out there, but like at what floor of the wealth elevator does it really pertain to? Right? Like, certainly not drinking your $6, $8 latte doesn't pertain to us, right? But then you hear all these other things that make a lot of sense, but maybe it only pertains to the people in the basement, for example. So I think that I think I took the idea from one of Malcolm Gladwell's books or something like that, where it's, at certain stages, there's paradigms out there, right? And that's what the book is. There's different paradigms to the wealth building journey. At certain phases of the journey, these are the things to do. And you're going to phase out of that on the next floor.
Right. I like that. And is it available at major bookstores?
Yeah, iTunes, or not iTunes, at the Amazon. Yeah.
Amazon,
It's
yeah.
available on the Amazon.
At the Amazon. Okay. Very good. The other question is, how do you give back to your community?
I make myself available and I don't bullshit them.
That's good. That's great.
Time is a wasted when you're just like, I've seen how things can go bad, and sometimes these deals aren't right for a lot of people out there. Better to know this up front. And once you're in a deal, you're stuck. We are stuck with each other, right? It's better to have alignment of values from the get-go. It's like my 3-year-old daughter, always, we get in the car and she's like, I want out. I'm like, sorry, girl, we're on the freeway. Like,
yeah,
I'm sorry, can't get you out now to go to the bathroom, right? Oftentimes these deals last longer than some people's marriages.
Right.
We're stuck with each other. So you got to know what you're getting into, right? I mean, I think in the S deals, the way they should work is there's alignment of values, right? Your general partnership's trying to kick some butt, make some money for everybody, get compensated via carried interest to that. Sure, they get fees on the front load, but it's expensive to run a company, right? Like my payroll, I've had to decrease very greatly over the last few years with the downturn, but we're still, multiple 6 figures now per year. Maybe getting into the 7s at some point. I mean, it's very expensive to run these companies, but still, I think a lot less cost than the institutional operator out there. But I don't know. I haven't figured that one out. I'm still just trying to. And I think one way I'm trying to give back is a lot of. I have a lot of content in my earlier years when I started my podcast in 2016. It would be mostly with single family homes because that's what I was doing. Kind of at the time.
Yeah.
So I have a lot of content on free courses on how to buy a remote rental property for people getting started with that type of stuff. So my team always asks, like, why the hell are you doing this, Lane? It's like, I don't know, man. Like, if I die, just keep this thing going, right? Because out there's a 20-year-old Lane, maybe a 20-year-old John, just stuck in a job that you don't like. And you're working for some a-holes, right? Think about it. If you're at a job for 30 years, especially if you're in middle management, if you're that amazing, you probably have gone up to bigger or better things. But if you're middle management, you're not there because you're a shiny person, right? Because all the FI guys who hit $4 to $5 million net worth pieced out at that point already. You're there, they're grumpy. They're there because they have to be. And there's a lot of guys in their 20s, maybe in 30s too, that have to work under these guys. And it's just like soul sucking.
Yeah.
Right? if only they were able to buy some rental properties, or at least like when I was in my 20s, I had a few rental properties and I was like, there is hope. There is hope. I'm already making more money than my boss with these few rental properties on the side. There is hope for me. You know,
That's great. Well, thank you very much for your time, and thank you for the conversation. How can investors find out more information about the Wealth Elevator and your podcast? So is your podcast still live? The Simple Passive
yeah,
Cashflow?
yeah, yeah. I think we only do it like maybe every other week now.
Okay.
But yeah, I'd say the book on Amazon, or if they want to reach out, lane@thewealthelevator.com.
Got it. Okay. Yeah, and we'll include all that information in the description of this podcast episode, this webinar as well on YouTube. Don't forget to like and subscribe to our podcast on whichever platform you're listening to, and to make sure that we can help continue bringing you the best educational content. And thanks everyone. Until next time, keep learning to invest for generational wealth. Lane, thank you very much for your time.